Okay, what if I told you that some of the most widely accepted credit advice out there is actually, well, completely wrong? And worse, following it could be silently dragging your score down right now, secretly costing you thousands of dollars without you even realizing it. Welcome to this rapid-fire video briefing. Today, we're blowing up the bad advice you probably heard from your parents, your friends, or just floating around on the internet. We're going to expose the lies, and I'm going to give you a strict, actionable debt management plan that actually works. To totally respect your time as busy professionals, we've structured this video into 5 fast-paced sections. We'll start with why your score matters, break down those 5 costly credit myths, reveal the real scoring formula, lay out a debt management action plan, and finally, look at how to truly win the credit game.
All right, let's jump right in. Section 1, why your score matters. Listen, having a good score isn't about flexing on some bank. It's about having options and paying a lot less for literally everything money-related throughout your life. Just a 100-point difference? That could easily cost you or save you tens of thousands of dollars over the life of a mortgage. But it goes way beyond just buying a house. Landlords check it for apartment rentals. In most states, your score heavily dictates your car insurance premiums. And increasingly, employers are actually using your credit history in background checks. So when you get this wrong, it's not just a minor inconvenience. It's wildly expensive.
Which brings us to Section 2, 5 costly credit myths. Let's dismantle these.
You have definitely heard this first major lie. Oh, you got to keep a small balance on your credit card every month just to show the bank you're actively using it. I see this everywhere, and it's completely 100% false. The truth? Carrying a balance doesn't help your score even a little bit. All it actually does is bleed you for monthly interest. You want to pay your statement balance off in full every single month, period.
So if carrying debt isn't the metric banks care about, what is it? Well, instead of carrying a balance, you need to focus on managing your credit utilization. In simple, everyday terms, credit utilization is just the percentage of your available credit limit that you're actually using. Think of it like a pie. If you have a $1,000 limit and you spend $200, you've eaten 20% of the pie. The less of the pie you eat, the better your score.
The absolute golden rule of debt management is to keep that utilization rate under 30%. But if you want to play at the highest level, like the financial elite who are rocking scores of 780 and above, they usually keep it strictly under 10%. So if you've got a $5,000 limit, try to keep your balance under $500 when the statement closes, and then pay it off entirely. No interest, better score. Win-win. Moving to myth number 2. This one drives me crazy. People are terrified to check their own reports because someone told them it would drop their score. And because of that fear, they fly completely blind, and massive errors or fraud just go totally undetected. Here's the truth. Checking your own score has zero impact on your credit. Absolutely none. Zip.
Let's cut through the banking jargon here for a second. Checking your own score is what's called a soft inquiry, which is essentially just a background peek. Zero impact. On the flip side, a hard inquiry happens when you actively apply for a new loan and a lender formally reviews your profile. That causes a tiny, temporary dip, usually like 5 points or less. But checking your own score is always a soft inquiry. Knowledge is protection, guys, so check your score.
Okay, myth 3. This actually comes from a really good place. People pay off a card and think, you know what? I don't want the temptation. I'll just close it to clean things up. It feels like responsible debt management. But actually, scratch that. Closing old accounts quietly damages your score. It hurts you by shortening the average length of your credit history. And even worse, it drastically shrinks your overall available credit. Let's quickly look at the math behind this. Say you have 2 cards with a combined total limit of $5,000, and you've spent $1,000. Your utilization is a very healthy 20%. But if you close card B, removing its $1,000 limit, your total available credit immediately drops to $4,000. If you're still spending that same $1,000, your utilization percentage instantly spikes to 25%. You literally did nothing wrong. Your spending didn't change at all, but your score takes a hit because your utilization jumped. So keep those old cards open and let them age like fine wine.
From myth 4, here is a quick reality check. There is no single credit score. You actually have dozens of different ones. FICO alone has over 40 different versions of its scoring model, totally customized for industries like auto loans or mortgages. So please don't panic if the score you see on your free banking app doesn't perfectly match what a mortgage broker pulls. Just focus on the core fundamentals, and all your scores will rise together.
And our final myth is literally fantastic news. Your income is completely excluded from your credit score calculation. Let that sink in.
A person making $40,000 a year can easily have a much higher credit score than someone making $400,000 a year if they just manage their debt better. Income only dictates how much a bank will lend you, but the score itself is 100% based on your behavioral reliability. It is entirely within your control.
All right, Section 3, the real scoring formula.
When you finally break down the numbers, the whole game is surprisingly simple. Your FICO score is essentially a 5-piece puzzle. 35% is payment history, just paying on time, every time. 30% is credit utilization, keeping your debt low compared to your limits. Look at those two pieces right there. Paying on time and keeping your utilization low makes up a massive 65% of your entire score. The rest is just 15% for the length of your history, 10% for your mix of credit types, and 10% for new credit inquiries. Win that 65% majority, and you win the whole game.
Section 4, Debt Management Action Plan.
Taking all this knowledge, here's your strict executive-style playbook to push that score up starting today. Step 1, set up auto-pay for at least the minimum payment on every single account so you eliminate missed payments forever. Step 2, aggressively pay down your high-utilization cards first. That is absolutely the fastest score boost available. Step 3, check your report yearly at annualcreditreport.com for any weird errors. Step 4, stop closing those old accounts. And Step 5, only apply for new credit when you actually genuinely need it. Execute these 5 steps consistently, and your score will move. I guarantee it.
And finally, Section 5, winning the credit game.
Before we wrap up, we need a really quick reality check about the system itself. Remember this quote: "The credit score system was not designed with your best interests in mind. It was designed by lenders for lenders. The system literally rewards behavior that keeps you engaged with their debt products." That doesn't mean you ignore it, of course. Understanding it gives you massive leverage. But please, don't let chasing a 3-digit number become your ultimate goal. Your actual goal is holistic financial health, low debt, high savings, and living within your means. A great credit score should just be a natural byproduct of excellent debt management habits, not the final destination. So that brings us to the end of this video. I have to ask, which credit myth has been secretly costing you money? Drop a siren emoji in the comments below and let me know which of these surprised you the most. I read all the comments and I genuinely want to hear your experiences. Also, if you found this briefing valuable, make sure to subscribe, hit that like button, share this video with a friend or colleague who's still carrying a balance, and turn on the notification bell so you never miss our weekly tips. Thanks so much for watching, take control of your debt, and I'll see you in the next one.